The number sitting in your bank account feels solid, familiar, and safe, but it is quietly misleading you. That balance does not represent stability. It represents a promise that is being broken a little more every day. Without any dramatic announcement, without any obvious crisis, the value of that money is shrinking in real terms, even as the number itself stays the same or slowly rises. This is not the result of bad luck or temporary economic stress. It is not a failure of markets, and it is not a mystery that experts are struggling to solve. It is the deliberate outcome of a system designed to deal with a problem so large that admitting it openly would cause panic. The United States is carrying a level of debt that cannot be repaid honestly without collapsing the very structure that supports it. The people running the system know this. They are not trying to pay the debt back. They are trying to dissolve it quietly by reducing the value of the currency it is denominated in. Your savings are not collateral by accident. They are the mechanism. The strategy only works if it feels normal, gradual, and unavoidable, and if most people never realize that what looks like economic management is actually a long-term transfer of purchasing power happening in plain sight. The scale of government debt has reached a point where traditional solutions no longer apply. Raising taxes enough to meaningfully reduce it would cripple economic activity, while cutting spending at the required level would destabilize society. Economic growth alone cannot solve the problem either, because growth would need to outpace the debt by a margin that is no longer realistic. This leaves policymakers with a narrow set of options, most of which are politically impossible to admit openly. Rather than confronting the issue directly, the system has shifted toward managing appearances while allowing time and inflation to do the real work. When money loses purchasing power, debts denominated in that money become easier to carry, even if the headline numbers keep rising. The debt does not shrink on paper, but it shrinks in reality. This approach allows officials to claim responsibility while avoiding defaults or dramatic austerity. To the public, it looks like slow progress and persistent inflation. To those inside the system, it looks like the only viable exit. The key advantage of this method is that it does not require consent. No vote is needed to reduce purchasing power. No announcement is required to make savings worth less. The adjustment happens automatically, day by day, quietly shifting the burden away from the issuer of the currency and onto everyone who holds it. The erosion of purchasing power is made possible by the way inflation is measured and explained. Official statistics suggest that prices rise slowly and predictably, giving the impression that living standards are largely preserved over time. In reality, the costs that matter most to everyday life have risen far faster than the numbers suggest. Housing, healthcare, education, insurance, and energy consume a growing share of income, yet their impact is softened or delayed in the way inflation is calculated. Over decades, these adjustments have created a widening gap between reported inflation and lived experience. This gap is not a rounding error. It is the space where wealth quietly disappears. When inflation is understated, policies that would otherwise be recognized as harmful appear reasonable, even necessary. Savers believe they are being cautious, while in fact they are absorbing a hidden tax that never shows up on a pay stub or bank statement. Unlike traditional taxation, this transfer does not provoke resistance because it is difficult to trace. Prices rise, wages follow slowly, and the loss is blamed on markets, corporations, or global forces. The mechanism remains invisible, even though it operates continuously. The result is a system where people feel poorer without being able to clearly identify who took their money or how it happened. Interest rates are the central lever that makes this entire system work. If the government were forced to borrow money at rates determined purely by supply and demand, the cost of servicing the debt would explode almost immediately. At true market rates, interest payments alone would consume a staggering share of federal revenue, leaving little room for basic operations. To prevent this outcome, interest rates must remain artificially suppressed, regardless of inflation. This is why central banks intervene directly in bond markets rather than allowing prices to adjust naturally. By purchasing government debt with newly created money, they generate demand that would not exist in a free market, pushing yields downward and making borrowing appear sustainable. This process does not eliminate risk, it redistributes it. Savers accept lower returns. Pension funds stretch for yield. Asset prices inflate. Debt becomes easier to carry, while holding cash becomes increasingly irrational. What looks like monetary policy is, at its core, debt management. The stated goal may be price stability, but the operational priority is solvency. Once debt reaches a certain scale, controlling interest rates becomes non-negotiable. Every other objective, including long-term currency stability, becomes secondary. The system survives not by correcting imbalances, but by extending them over time until the cost is absorbed quietly by those least equipped to resist it. As debt grows and interest rates are held below natural levels, monetary policy gradually loses its independence. At that point, the central bank is no longer free to act purely in the interest of price stability or long-term economic health. It becomes constrained by the government's financing needs. Raising rates aggressively to fight inflation would immediately increase debt servicing costs to unsustainable levels, risking a fiscal crisis. Lowering rates too far would accelerate inflation and undermine confidence in the currency. The result is a narrow corridor where policy is carefully calibrated to manage optics rather than solve root problems. Small rate hikes signal discipline while being limited enough to avoid destabilizing government finances. Inflation is acknowledged but tolerated. This condition, often described as fiscal dominance, marks a fundamental shift in how the system operates. Monetary tools become instruments of debt containment rather than economic balance. Inflation stops being an enemy to defeat and becomes a tool to manage. The public experiences this as a confusing mix of rising prices, shifting narratives, and policy reversals that never seem to resolve the problem. Inside the system, however, the objective is clear. The goal is not to restore the purchasing power of money, but to gradually reduce the real weight of outstanding obligations without triggering a collapse in confidence. The real cost of this system becomes visible when you look beyond nominal balances and focus on real returns. Money held in savings accounts, fixed deposits, or low-yield instruments may appear to grow, but when inflation consistently runs higher than interest earned, those gains are an illusion. The account balance increases while purchasing power quietly shrinks. Over time, this erosion compounds into a significant loss, even though nothing dramatic ever appears on a statement. This is why many people feel they are falling behind, despite doing everything they were told was responsible. Saving no longer preserves value in a system designed around debt erosion. Instead, savings become a funding source. The loss does not feel like theft because it happens gradually, spread across years rather than days. Yet mathematically, the effect is the same. Wealth is transferred from those who hold currency to those who issue and spend it. When this process is scaled across an entire population, the numbers become staggering. Trillions in real value are absorbed without a single vote, law, or announcement. This is how debt burdens shrink without repayment. Not by defaulting, not by growing out of it, but by allowing time and inflation to do the work quietly, while savers absorb the cost. As purchasing power erodes, behavior across the economy begins to change in predictable ways. People instinctively move away from cash, not because they have studied monetary policy, but because holding money feels increasingly pointless. Assets that appear risky in normal conditions begin to feel safer than guaranteed losses. Capital flows into stocks, real estate, commodities, and alternative investments, not necessarily because they are productive, but because they offer protection from currency dilution. This shift pushes asset prices higher, often far beyond what underlying economic fundamentals would justify. What looks like exuberance or speculation is often defensive behavior. The system quietly forces participation. Those who remain cautious fall behind, while those who take risk are rewarded, at least temporarily. Policymakers then point to rising markets as evidence of economic strength, even though much of that growth reflects monetary distortion rather than genuine productivity. This dynamic creates a widening gap between asset owners and everyone else. People who already own appreciating assets see their wealth grow, while those dependent on wages and savings watch the cost of living outpace their income. Inflation becomes a sorting mechanism, rewarding exposure to assets and punishing restraint. The consequences of this system extend far beyond national borders, amplifying its effects through the global financial order. Because the dollar sits at the center of international trade and reserves, foreign governments and institutions hold massive quantities of U.S. debt. When inflation reduces the real value of that debt, a significant portion of the loss is exported overseas. These foreign holders understand what is happening, but they are trapped. Selling large amounts of U.S. debt would destabilize global markets, raise interest rates sharply, and damage their own economies. Holding depreciating assets becomes the least painful option. This creates a silent transfer of wealth from foreign savers to the U.S. government, repeated quarter after quarter. The process functions without confrontation or negotiation because it is embedded in the structure of the system itself. Currency weakness abroad forces other nations to respond by weakening their own currencies to remain competitive, importing inflation back into their domestic economies. Living standards erode globally, not because of local policy failures, but because the dominant currency is being managed to solve a debt problem at scale. What appears as normal global finance is, in reality, a coordinated redistribution driven by necessity rather than choice. The next phase of this system is already taking shape through digital financial infrastructure. Central bank digital currency frameworks are being developed under the banner of efficiency, security, and modernization, but their deeper function is control. Unlike physical cash, digital currency allows complete visibility into transactions and balances in real time. This creates the ability to enforce policy directly rather than indirectly. Negative real returns no longer require inflation alone. They can be implemented through programmable rules. Spending can be encouraged or restricted, savings can be penalized, and wealth can be redistributed automatically through code rather than legislation. These tools represent the most advanced form of financial repression ever conceived, not because they rely on force, but because they normalize compliance through convenience. The transition does not need to be sudden or mandatory. It can happen gradually, as incentives push people towards systems that feel easier and safer. Once established, resistance becomes difficult, not politically, but technically. The public narrative focuses on fraud prevention and financial inclusion, while the underlying capability quietly shifts power away from individuals and towards centralized authorities. What was once managed through markets and expectations moves into direct administration. For individuals trying to protect themselves, the implications of this system are uncomfortable but unavoidable. Holding cash guarantees a slow loss of purchasing power, while traditional fixed income investments offer little refuge when yields remain below inflation. The system quietly pushes people toward risk, not as a choice, but as a necessity. Markets that once rewarded patience and caution now punish them. This creates a distorted environment where overvalued assets become the least dangerous option simply because everything else guarantees loss. Even strategies that feel conservative on the surface are exposed to erosion when they are denominated in future dollars that will be worth less than today's. Understanding this does not eliminate uncertainty, but it changes the framework for decision-making. Protection becomes less about avoiding risk and more about avoiding certainty of loss. Real assets, productive enterprises, and diversification across jurisdictions begin to matter not as speculative bets, but as defenses against systemic dilution. The rules that govern saving for decades have quietly changed, and those who continue to follow them without adjustment are unknowingly volunteering to absorb the cost of debt reduction. As this process continues, it becomes clear that it is not temporary or accidental, but structural. The system is designed to persist until the debt burden reaches a level that appears manageable relative to the size of the economy. Nominal growth, fueled by inflation, makes balance sheets look healthier even as the real value of obligations is reduced. Officials can point to improved ratios and claim success, while the public struggles to understand why life feels more expensive despite economic progress. This is the quiet endgame of debt saturation. There is no dramatic default, no sudden collapse, and no moment of obvious failure. Instead, there is a long period where currency loses meaning slowly enough to avoid revolt, but fast enough to solve the problem. By the time the average person realizes their savings by far less than they expected, the objective has already been achieved. Debt appears under control, markets have adjusted, and a new baseline is established. The transition feels frustrating rather than catastrophic, which is precisely why it works. Pain is distributed over time, resistance is diffused, and accountability fades into abstraction. This system does not depend on secrecy or deception. It depends on complexity, patience, and time. Everything happening now is openly documented in policy papers, economic models, and official projections, yet very few people connect the outcomes to the mechanisms producing them. By the time the effects become undeniable, the transfer will already be complete. Savings will still exist on paper, but their purchasing power will be permanently reduced. Officials will point to stabilized debt ratios and claim responsible management. Economists will describe the period as a successful adjustment. Meanwhile, millions will quietly wonder why decades of careful planning no longer deliver the security they expected. This is not a dramatic collapse. It is a controlled rebalancing, achieved by spreading loss thinly enough that it never provokes collective resistance. Awareness is the only real defense. Understanding how the system operates does not eliminate risk, but ignorance guarantees loss. The mechanism is active, the mathematics are unforgiving, and the timeline is already unfolding. What matters now is whether you recognize what is happening early enough to adapt, or whether you remain on autopilot while your purchasing power is gradually converted into a solution for a problem you did not create. The choice is not comfortable, but it is unavoidable.